All right, everyone. Thank you very much for joining us today on our segment on how to properly insure your IRA-owned investment properties. My name is Alex Perny. I will be your moderator today. I have been handling self-directed IRA investments and the like for about 7 years now. I'm a certified IRA services professional and a member of the American Trust Banking Association. And one thing I've learned through all of my time doing this is the one common factor between everyone that buys IRA property, whether that's vacant land, whether that's a single family home, duplexes, it gets into commercial, is that everyone pretty much needs insurance. And it specifically to this type of investing leads itself to a few more questions than maybe can be answered by your local State Farm agent or your Progressive agent that just kind of deal with the owner-occupied stuff that is, a little bit outside the realm of directly dealing with investors. I had the pleasure of hearing Shawn speak at a local real estate investment group down in Sarasota, and was very intrigued by what he had to say. He was very informative and knowledgeable on all aspects of insurance, to the point where what can be probably most of the time a relatively dull subject was completely fascinating. So we wanted to bring him on today to give you great information and really kind of illustrate just exactly what it means to properly insure your properties that are investments. Because it's one thing just to have insurance, but understand what the needs are of your particular market, what type of coverages you need, what type of coverages you don't, the differences in the types of coverage that are out there, because not all types of coverage are the same. Just because you have a policy for X amount of dollars does not mean that it pays out the same in the event of a loss, nor does it mean that it covers the same things in the event of a loss. So as far as my knowledge on insurance goes, those are some definitely limiting factors. So a few things that we do want everyone to take away from today is that there are differences in coverages. There are many different types of plans out there that you can have, what they mean for you, what it kind of means to have different things like umbrella policies, what it means to have loss coverage, and all the different things that go into that. And Shawn will certainly enumerate on that. Ensuring that your personal investments are somehow not just all lumped in with your IRA investment properties. And I do know that Shawn and his group have special experience with making sure that invoices are properly separated out, and that when you're insuring stuff that you have the proper insured parties just relegated to your IRA-owned portions of these things, as not kind of directly lumped in with your personal investments. So I do know that we have clients directly that have used this kind of service. But moving right along, so just understanding the types of coverage that you need and the points to take away from as they're enumerated up here. So we will move along. A bit about us: we are a nationwide self-directed IRA administrator. We handle hundreds of millions of dollars worth of real estate investments for our clients. So that's why it's especially germane for us to have on speakers that can speak to the topic of making sure that your investments are insured, especially for people like the real estate investor. This kind of thing is very important. We maintain offices in Florida and Georgia. Our corporate headquarters is down here in Largo, Florida, in the Tampa Bay area. So if you do have questions, we are local to those markets, but we also deal nationwide and internationally as well. So please do let us know if you have any questions. If you're new to self-direction and you're kind of curious on that aspect of it, most IRA administrators just won't handle self-directed type investments. So if you go to someone like Fidelity or Charles Schwab and you'd like to buy real estate, their heads might spin a little bit, but you can do these types of things and get all of the great tax benefits by utilizing an IRA or qualified plan to invest in real estate without having to take money out and take a large tax or penalty hit for that. So just understand that we're here to help when it comes to getting those types of investments into your qualified plans and helping you avoid quite a bit of taxes in the process as well. So let me just pull this up now. Excuse me, sorry. And now I will turn it over to Shawn. Shawn with the National Real Estate Insurance Group. Again, a great speaker on the topic, a wealth of knowledge. I've heard him speak before, and the second I heard him speak, I knew that we needed to have him on to help properly educate our clients and others on the need for insurance in different markets, what it means to properly insure a property, what it means for your own area to have the proper type of insurance, because people in Florida definitely don't need as much volcano coverage as someone in Hawaii, and we certainly get more hurricanes than people in Arizona. So it's one of those things to certainly be cognizant of, and making sure that when you do get these policies that you understand the coverages, where you need to spend money, maybe where you can scale back a little bit as well. So also please make sure that you use this as a resource. Type in your questions really quickly. This is a good chance for you to ask someone who is an expert in this, any insurance questions you have. So I will moderate those. Just type those into the chat box. And without further ado, I'm going to hand it over to Shawn. Shawn, take it away.
Wow. Thank you, Alex, so much for having me, and thank you, everyone, for dialing in and taking time out of your day to listen to property insurance and the right way to invest in and to insure your properties, because not always the most riveting subject, but we'll make it as interesting as we can. If I can take the first couple of minutes really and quickly tell you who National Real Estate Insurance Group is, who NREG is, and then we'll kind of dive into some options that you guys have as investors. So National Real Estate Insurance Group is an independent insurance agency. We're national. We're active in all 50 states and licensed. And about 20 years ago, we built what is now called the REI Guard Insurance Program, so Real Estate Investor Guard. So just as it sounds, it's developed and built specifically for the residential real estate investor. And it's specifically focusing on 1 to 4 family rental dwelling portfolios through any phase of occupancy. And the advantage being is it will take your occupied locations, your vacant, any locations undergoing renovation, and collectively we house all of those locations on one single schedule and allow you as the investor to pay monthly if you choose to. So it's a monthly reporting form. Now we'll dive into some of the IRA questions that go along with that, because that's not always the best option to move forward with on a location purchase through an IRA. But know that the other locations that you may have in your portfolio that you own personally or through an LLC or another owning entity can pay monthly if you choose to. So the big advantage being is being able to accommodate for those locations through any phase of occupancy, but more importantly, taking the portfolio that you've built as an investor and leveraging that with our program underwriters. It's only going to stabilize and drive down your property costs per location. Take, for example, maybe you have a portfolio of 10 locations or 50 or 100. If you're purchasing individual policies for each and every one of those locations, you're at the mercy of the underwriter on what they feel is an appropriate rate assigned to each risk, which, by the way, can be very different depending on where the risk sits, what the occupancy is, and certainly what the loss experience is. So by bundling your portfolio together and allowing to take the success of your business to allow me leverage to go to the underwriter and actually drive that cost down is a win-win. Now, the nice part about our program, and we're really one of the only ones in the country that does this, is being able to accommodate and list the IRA as the first name insured, right, which really no one else can do. And if you go to your State Farms or Nationwide of the world, many of them can't do that. So it allows you to, we can actually bill the IRA as the first name insured, and pay it from your IRA, so it kind of gets around any kind of tax ramifications by not doing it correctly. Okay, so with that being said, let's talk about how to properly insure your real estate investment properties. Okay, because the one thing I really want everyone to take away from today is that you as an investor have many choices. It's not a one-size-fits-all model. You should be able to challenge your agent to have you come through for you with different options and coverage specifics and values, and certainly rates, coverages, deductibles. We'll dive through all of them, but we should structure the coverage and the policy that's right for you as the investor. Okay, a lot of this presentation will be geared towards property coverage and what you have in terms of choices when it comes to coverage forms and deductible structures and things of that nature to really drive down your costs or minimize your risk based on what your appetite for risk is. And then we'll kind of jump into some liability options at the end as well. Okay, so to start off with, the first one I want to take a look at is basic coverage versus special form coverage. These are two property forms that you as an investor have an opportunity to engage in. And like Alex mentioned at the beginning of the webinar, is really you need to think about a few things. You need to consider the occupancy status and what the history is at that location, certainly where you're investing in the country, and what your appetite for risk is. Maybe you're a risk taker. Maybe you understand that, hey, I just want the minimum amount of coverage. If something were to happen that's not catastrophic, I'm probably just going to fix it out of pocket. Or maybe you're on the other end of the spectrum and say, hey, I have really no appetite for risk, and I want the most comprehensive coverage form that's available to me as an investor. So it's important that, A, you don't overpay for coverage, But B, you also never give an insurance company a reason to decline a loss that you're not comfortable insuring yourself. Okay, so let's kind of dive into special form coverage. That's the easier of the two. That is considered all risk coverage. So unless a peril is specifically excluded off of your policy, then coverage is afforded to you following a property loss. The burden of proof at that time following the property loss, the burden of proof falls on the insurance company to come to you and me as your agent and prove to us that the loss that happened did so from an excluded peril. So as you can imagine, it's a little bit difficult to do. Now, regardless of where you purchase your insurance from, there are some standard exclusions off of every special form policy that you need to be aware of. Those are mold and fungus, wear and tear, sewer and drain backup, earthquake, flood, everyone's favorite, which is intentional tenant damage. So if your tenant busts your house up on the way out, that's an uninsurable risk. So that's excluded off of every policy. And then you have, equipment breakdown, ordinance or law, vermin, nuclear hazard, war, government action, and then obviously faulty craftsmanship or during repair time. So, but other than that, unless specifically excluded, and there are manuscripted forms out there that you need to make yourself aware of, and be sure that you look through the exclusions pages and endorsements to your policy from the get-go. Other than that, unless specifically excluded, coverage is afforded to you following a loss. Now, you have to be very careful in Florida as well, and you have to be very careful in parts of Georgia that are touching the coast, because named windstorm coverage is very different from wind and hail. And guys, that holds true with Louisiana, Mississippi, Alabama, Texas, and all the way up the East Coast until you get into Maine. So if you have wind and hail coverage, that's great, but it's very, very different from named windstorm coverage, which would extend to hurricanes, tropical storms, tropical depressions, really any kind of storm that's named by the National Weather Service. So it's important that you kind of look through that if you're coastal exposed and have the potential of getting hit with hurricane damage. Basic form, however, is another option for you to consider. It does save you about 30% per year. Depending on the carrier, it ranges 25 to 30% per year, but does come with a few additional exclusions that you need to make yourself aware of. Now, to keep in mind, if you're willing to self-insure these additional exclusions, by all means, look at basic form as a viable option to save some money on your insurance costs. Those additional exclusions are going to be theft, which if you think of theft coverage, you've got to think theft is anything that you own in the home. So it could be the air conditioning unit, or if someone comes in and rips the copper out of the walls, something like that. All your tenants' belongings that are in the house, if they're stolen, they're going to need a renter's policy to kind of cover those objects, and we'll kind of go into that in the future here on later slides. Weight of ice, sleet, or snow, which if you're investing in the southeast or certainly in Texas or out west, is that really an exposure that you need to cover, right? Water damage. If you think of water damage is really internal type water damage. And the most common thing we see in our program, and we insure over 100,000 locations spread across all 50 states, but we're heavily saturated in the Midwest. We're a Cincinnati and Kansas City born company. We see frozen pipes that burst in the wintertime. Again, if you're investing in Florida, it's probably not too big of a risk for you. Falling objects, which is exactly what it sounds like. It's stuff that just doesn't happen. Stuff falling off of an airplane, or random pieces of junk falling out of the sky, a nice healthy tree that falls over that wasn't associated by a wind or hail event. Very, very rare that those things happen and then collapse. So if you are willing to self-insure those additional perils that we just went over, think about basic form as really a viable option to save 25 to 30% annually on your insurance costs. Diving into the next slide, another option that you have is going to be an actual cash value policy versus a replacement cost policy. Now, one of the caveats that I didn't mention at the onset of this is you've always got to consider, if you've got a lender on one or all of your locations, they're always going to have insurance lending requirements. They're going to say, hey, if we're funding this deal, you as our borrower have to carry these minimum expectations for insurance. So if your lender tells you that you have to have special form coverage, you can't purchase basic form. And that's something that us as your advisors will actually look at on your behalf and make sure that we meet or exceed your lending guidelines each and every time. Okay? The second option is going to be, like I said, actual cash value versus replacement cost. Actual cash value in return for allowing you to insure your property to a lighter valuation per square foot does limit you as an investor to one claim settlement following a property loss of any size. Okay, replacement cost by definition simply provides you with the ability to go back and recover depreciation that's initially figured against you in the claim settlement process. So the easiest way for us to do this is let's go through a quick claims example so you can kind of figure in about, which is going to be better for you. Keeping in mind that while we go through this, A, what would you do? Think about what you do following a total loss. Would you rebuild the property? Maybe it's cash flowing for you very well. Maybe you've got a lot of people that are just waiting in line to rent this property from you. So if it were to burn to the ground, you'd certainly want to rebuild it. Or B, would you clean the land up, sell it, move on to your next opportunity? Because that should really be the deciding factor on whether you decide to carry actual cash value or replacement costs. And there's about another 20 to 30% difference in cost annually between the two. So let's look at a partial loss. And by the way, that's probably about 90% of what the market experiences in the residential real estate investment field is a partial loss, right? A kitchen fire. Maybe one of your tenants leaves a candle burning that burns out burns out your living room. And let's just say that kitchen fire costs the $30,000 loss. Okay. At the time of loss, the adjuster that's assigned by the insurance carrier is going to come in. They're going to figure out how much useful life was left and what was damaged. So they can figure in the depreciation percentage to take from you in your loss settlement. And for a nice round number, let's say they depreciated at 40%, which, by the way, is more than you're probably ever going to see, but it makes for a nice round number of depreciation. In this case, they would take $12,000 off of your $30,000 kitchen fire. That's going to leave you right now with a settlement of $18,000. And then they're going to look at your deductible. And for another nice round number, let's say you have a $3,000 property deductible. That's going to leave you with a $15,000 settlement for your $30,000 kitchen fire. Now, on actual cash value or replacement costs, this is the initial settlement check that you receive from your insurance carrier. On actual cash value, that's all you can receive, though. It's all you're eligible to get back. But what you do with that money is completely up to you. You're not under any obligation to make the repairs to the property. You can sell it with the existing damage, take the $15,000, cash out, and move on to your next property. That's why you have insurance. On replacement costs, you've got the ability to go back and recover the depreciation that was initially taken from you in the claims process, which in this example was $12,000. But in order to do that, you've got to do a few things. Insurance companies, unfortunately, won't just cut you the check for $12,000. You've got to prove to them that you need it. So you're going to take the initial $15,000, exhaust it on the repairs of the home. You're going to make the remaining repairs out of pocket, at which point you can submit those receipts to your insurance company, and they'll reimburse you for up to the $12,000 that they took from you originally. The only amount that you're not able to get back is your deductible. That's the amount that you have agreed to self-insure, for a lack of a better term. So that's why I say think about a total loss, because insurance companies and adjusters, they settle property losses on what are determined to be retail costs at the time of loss. Well, nobody on this call is paying retail for labor or materials. Typically, you've got your own crew or you're doing things yourself, and you're getting things done for substantially less than what a State Farm or a Lloyd's of London thinks you can. So always think about what you do on a total loss situation, because never would an actual cash value policy, even if paid in full for up to the value of the actual policy itself, it's never going to be enough to rebuild that property the way it was. So if you even are thinking about, maybe I would rebuild following a property loss, a total, you want to carry replacement costs. It's going to give you the ability to get that depreciation back and make you whole again. And then on a quick side note, just so everybody's thinking, hey, depreciation is tricky, right? And we wonder how can I kind of ballpark what I would be looking at as from a depreciation following a loss tomorrow or next month or next year. Everything depreciates at a different level. Okay, roughly it's about 1% per year from the last updates. So not the year built, but the last updates. The exception of that's going to be the roof. The roof's going to deteriorate at an accelerated level due to the constant exposure to weather. Now, that's why most policies, if not all, now come with an ACV or an actual cash value endorsement on the roof at a certain year mark. So most carriers are at 5 to 7.5 years, meaning that even if you purchase a replacement cost policy, your roof's going to be settled on actual cash value once it's 5 years and 1 day old, or 7.5 years and 1 day old. Depends on the carrier. Ours is 15 years and 1 day, so we'll allow you to keep replacement costs for a little bit longer in our program. So kind of keep that in mind. But that's really the difference between the two. And the only increase in cost between actual cash value and replacement cost is the difference in valuation per square foot that you're required to insure your property for to garner replacement cost as opposed to actual cash value. So again, every carrier is different with their appetite. In our program, I can tell you that we begin insuring properties at $50 per square foot. So a 1,000 square foot home, we would insure it to $50,000. And that's on actual cash value with no co-insurance, and we'll touch on that in just a second. The Garner replacement cost, you've actually got to insure the property to $70 per square foot or higher, again with no co-insurance. So that difference between $50 a square and $70 is really the added cost between what you would experience between an ACV or replacement cost policy. Jumping into the next slide. Co-insurance provision, and this is one that kind of stay with me. It's a little bit tricky because it's a lot different than what you see as co-insurance on a health insurance policy. Co-insurance is a tricky way. Yes.
Just real quick, sorry, my microphone was off, and I asked a question to Space there real quick. If we can just go back one slide real quick, just before we move on with regard to the actual cash value, like rider on a roof, when do they start calculating that date of replacement? Is that the calendar year or the actual date that the work was finished? So if you had the roof replaced in December, do you kind of get like an extra partial, do you kind of lose part of that? Or if it was replaced in January of the following year, do you kind of get a little extra? How do they calculate the timing on when they do certain things from the date purchase?
Yeah, it's actually off the actual date itself of the improvements, not the year.
Okay. Good, because especially with some of the stuff in our industry with IRAs and retirement planning, there's some like interesting crediting options with regards to when you start something and getting credit for full years versus partial and qualifications for that. So I just wanted to clarify that for everyone.
Yeah, great question.
All right, great. You can go ahead and move on.
Awesome. Going back to co-insurance, and kind of going into this, guys, I challenge everyone, and this is the big part of why I do what I do and going around and educating different groups as much as I possibly can on insurance and try to avoid situations happening that can harm you as an investor and potentially cost you your business. And if you've got a co-insurance percentage on your current policy, and it's very easy to see, guys, if you look at the declarations page to your policy, it's usually going to be listed right next to the building value or the deductible structure. It's going to show 80, 90, or 100% as a co-insurance clause. The higher it is for you, the worse it is for you. And most companies, if you go back to your agent and you say, hey, I want to waive co-insurance or go with an agreed value policy, they can accommodate for that. There's going to be additional charge associated with it, but it's well worth doing. So drop them an email, call them and find out what you need to do as an investor to get co-insurance removed from your policy. So what is co-insurance? Co-insurance is kind of a tricky provision that allows an insurance company a way to greatly diminish the amount of money that you recover as an investor following a property loss of any size by determining that you're underinsured at the time of loss. And that's the tricky part, right? Because until that loss happens, replacement costs can fluctuate very much. It can depend on the type of loss. Maybe it's a hurricane that does massive amounts of damage. At that point, maybe a replacement cost on a property that maybe was $80 a square foot goes to $110 or $120. So it's difficult. So let's look back at the partial loss, the kitchen fire that we just went over with the actual cash value versus replacement cost. At the same time when that adjuster's figuring out the depreciation, they also are going to review the policy that you've purchased. And they're going to look at it and say, wow, you've got an 80% co-insurance clause on this policy, which is about that's the most common one that you're going to experience as an investor. And at that time, they're going to say, well, had this burned to the ground, how much would it cost to rebuild? And let's just say for a nice round number, they determined that it would have cost $100,000 to rebuild from the ground up. They're going to refer to the deck pages to your policy, and they're going to say, hey, you've got an 80% co-insurance clause. You're agreeing to be insured to 80% of the true replacement cost of the property at the time of loss, which I just determined to be $100,000. So provided that your deck page shows $80,000 of property coverage or better or more, you've met your co-insurance clause. But if you're insured to under $80,000, your insurance carrier is going to assess a co-insurance penalty, and they do this based on the percentage you're underinsured prior to figuring in the depreciation and your deductible so they can take it off of a higher value. Okay, so that's where it can really hammer you. And I say that and why I'm so passionate about no co-insurance for investor policies and why we've negotiated with our carriers that provided you're insured to $50 per square foot or higher, there is no co-insurance, is because I have a very, very good friend of mine who's been a client now for years. But, 10 years ago when I met him, he was just getting started, came to me and had just suffered a total loss on one of his first investment properties. Lightning struck his building and it burned it to the ground. Actually burned the detached structure to the ground as well. At the time, he had insured the property to $100,000 on actual cash value with an 80% coinsurance clause and a $10,000 property deductible. At the time of loss, the adjuster assigned determined it was going to cost $230,000 to rebuild this piece of property to the way it was. That left him about 54% underinsured. So following the actual cash value settlement, the depreciation, the coinsurance percentage, and his deductible, he made about $22,000 on a $230,000 total loss. And it was all because his agent didn't explain what the consequences were to purchasing a cheaper policy. Cheaper is never better when it comes to insurance. So knowing that, I took some time. I went down to, it was about a 2-hour drive. I went down to see him, explained to him what he had and what he didn't have. And, fortunately he's rebounded. He's got about 500 locations insured with us now, but that could have put him away right from the get-go before he even got started. So all these little, clauses and different kind of verbiage in an insurance policy that can potentially harm you, that's what we want to get around and make sure that we avoid. Okay, so anything you can do to avoid coinsurance on your property policy, absolutely do it. And builder's risk policies is where the coinsurance can become so relevant, and you see it more often than anywhere else. And that's because builder's risk policies usually will assign a coinsurance percentage to the existing structure, because usually that's deteriorated, hasn't been updated, and then certainly it's also going to most oftentimes put a coinsurance percentage on your renovations or betterments and improvements as well, with an exception to us and maybe a couple of others who, again, we're going to waive coinsurance, knowing that it's in your best interest, that we don't want you having to play a guessing game following a loss. I want to point out on builder's risk policy that builder's risk is a very overused term in the insurance industry, unfortunately. Usually what that should mean is ground-up construction. So you buy a piece of land, you pour the foundation, you build the property from the ground up. However, it now can accommodate also for existing structures that are in need of improvement, right, prior to occupying. So you've got to be careful on these, because they are considered very high risk by the insurance industry, and oftentimes come with what are called a fully earned premium at the inception, or a fully earned clause at the inception of the policy. So maybe you've got a property that you know that you're going to purchase, and you think it's going to cost, it maybe be 6 months to flip the property, so you go in and you buy a 6-month policy, or maybe your insurance company requires you to pay a full year, right? Because it's, again, they're trying to collect enough premium to offset the additional risk they feel that they're taking on. But being fully earned at inception means that if you flip that property early, maybe you get the renovations done in 3 months and you sell the property right away, you have no need for that insurance policy anymore. So when you go to cancel it, they're happy to do it. They'll want to get off risk as well. But they're not going to repay you for any of the money that you would have, rightfully yours for the unused time of the premium or the policy term, because they're fully earned at inception, meaning that the second that you buy a 6-month policy, you're paying us for 6 months, and if you flip it early, great, but we're keeping all your money. You've got to be very, very careful on that. So if you think you've got a chance of maybe flipping that early, buy a 3-month policy, or you engage with us or another one of these programs that are out there similar to us that are a monthly reporting form. It's a pay-as-you-go form. So if you've got a flip in your possession 30 days, maybe you're a wholesaler, maybe you're going to wholesale the property in 30 days, you pay us for that 30 days of coverage, and then nothing else is owed. Also, one last point on builder's risk, and we'll move on to the next slide. Builder's risk with the majority of companies is a property-only form, okay, meaning that any liability exposure that you have at the property, slip and falls, personal injuries, things of that nature, there's no coverage extended to those unless you specifically ask for it from your carrier. Understanding the business as well as we do, and knowing that we're all residential real estate investors ourselves, when we built our builder's risk forms and our coverage options for builder's risk policies or locations, we included that liability coverage in that, because it makes no sense for us to exclude it. But be very careful, because it is typically a property-only form. So how do property deductibles work? And notice that I put property deductibles in there because this only applies to the property itself. So if you try to negotiate on your liability deductible, it can get you in a world of trouble with your carrier, and it diminishes your ability to actually get coverage, because a lot of them will run the other direction, and I'll touch on that in just a second. But property deductibles are another way for you to control your insurance costs long term, and another opportunity for you to go home and look at the deck pages of your policy and then find out if your deductible is in line with what your appetite for risk is. So, and the reason I say that is the higher the property deductible that you can stomach or you can take on or that you're comfortable with, the lower the property rate. So if you're thinking, wow, the minimum loss that I'd ever turn in that I couldn't fix out of pocket is maybe $5,000. Maybe it's $10,000. Maybe it's $500. Every investor is different, and potentially every property is different. But you want to think about that before you decide on what deductible to choose. What we always advise our clients is start at that number and go as much as double that, and that's about the property deductible that you should carry. So if you go and you're thinking to yourself, maybe, hey, I wouldn't turn anything under $2,500, but then you look at the deck page to your current property policy, and you're carrying a $500 deductible, you're paying your insurance company a lot more money than you should, because that difference between a $500 to $2,500 deductible could be upwards of 15 to 20% savings, per year on your insurance costs. Start multiplying that by the number of locations that you own, and as your portfolio grows, you're talking about some substantial savings. So if you're carrying that deductible that's lower than what you would want, again, go back and challenge your agent. They're there to work for you and give you options that are best protecting you and your investment. And email them and say, I want to increase my deductible. How much savings will it give me? A lot of companies can do that and can accommodate for it. Some cannot. So if you get your agent that comes back to you and says, hey, there's no advantage to you increasing your deductible because your company doesn't rate for that, that means in most cases you're probably with the wrong insurance company and they don't have an appetite for the risk they're taking on. Investment properties are very, very different, and a lot of carriers don't like insuring them. So they assign a specific rate and a specific dollar amount, knowing that's exactly what they want to get out of it to take on the risk regardless of what your out-of-pocket exposure is.
So, Shawn, that brings up a really good point with regard to, obviously everyone's bottom line is going to be different, and your toleration of expenses can be different. But is there any correlation between the amounts of coverage or the types of coverage you get and the amount of the deductible that you are able to write into a policy, i.e. you can only get certain types of coverages, or they will only, cover up to a certain amount with a certain deductible? Is there any type of correlation, or is it really just kind of personal preference on how much you would really like to pay for the most part? If you could elaborate on that, that'd be great.
Yeah, absolutely. So on our side, the only time that you see that is on an earthquake or a named windstorm type of peril, where the carrier itself assigns a higher deductible because of the increased exposure and potentially, catastrophic type losses or events that happen. If you're looking at a property deductible for simply, fires, lightning, straight line wind and hail, usually that's more mandated by the lender, if there is one in that case, than it does for us. So if I've got a client that has maybe one location, they want to insure it to $50,000 and they want to take a $10,000 deductible, at that point I'm going to probably talk to them on that's pretty an extreme case, and say, hey, you might want to look at, decreasing your deductible substantially, and this is why. But a lot of times those are mandated by a lender. They're going to say, hey, that the maximum deductible you can carry is $2,500 or 1% of the total building value. But in our case, no. We're happy to work with the investor and help them on what works best for them.
Great. Yeah, and I'm assuming that most of the time those kind of restrictions on lenders are more towards the owner-occupied stuff, with the investor side and hard money being what it is for investors, that it's probably a touch more flexible when it comes to the investor side of things, correct?
It is, yeah. You're starting to see that tighten a little bit. But yeah, in the past they're a little bit more flexible when it comes to deductible options for investors. Yeah.
Okay.
Okay. Going into the next one, and that's really, if you look at the property options that you have, there's a few items that you can consider to maybe save 25-30% or more on your property costs if you're going to take on some more risk, right? Liability, let's start with the deductible. Those are typically set by the carrier. So if it's usually first dollar coverage, meaning there's no deductible that you as the investor are responsible for, or maybe they have $1,000 deductible at the time of loss. If you go to increase that, that's where they start to get a little bit sketchy, or they get a little bit scared, because when you're looking at liability losses, frequency is just as bad as severity. And when they look at an investor that says, well, maybe I want to carry a $5,000 deductible, the insurance company themselves look at that and say, well, what are they trying to cover up, right? Maybe it's a string of slip and fall occurrences that were minor payouts from a medical expense. Maybe somebody slips and falls and twists their ankle. There's a sublimit assigned to your liability policy to kind of pay that person, for a lack of a better term, to go away. And usually that's anywhere from $1,000 to $10,000 depending on the carrier. So if you see a string of those, it's only a matter of time before one of those is really, really substantial in the insurance company's eyes, where it could pay hundreds of thousands of dollars out, which is why they say, hey, we're not going to mess with the deductible. It is what it is. Take it or leave it, and don't try to negotiate it. Liability policies, I just want to kind of hit you with some facts and more some recommendations. Starting off, I would tell you that in 12-plus years of experience, I've never seen a commercial liability policy that I would allow my investor to engage in that is less than $1 million per occurrence of coverage, with a $2 million what's called annual aggregate limit. So think of the aggregate limit as the maximum amount of coverage that you have for any number of losses that happen over a 12-month term. It's going to reset to a new limit at your renewal each year. Now, the reason I say that is, and you're probably looking at your deck pages, or you will be in the future, and you look at it and say, well, I've got $300,000 or I've got $500,000, because there's a lot of other options available to you, but they can get detrimental. And the reason I say that is defense costs. So when you go to $1 million limit per occurrence and a $2 million aggregate limit, like what we offer per location, so they'll never go to a shared policy when you have multiple locations and they're sharing in that limit, makes it impossible to get umbrellas and additional liability coverage, and it's a greater chance you eat away at that aggregate. But defense costs are outside of that limit. So when you buy a policy for $1 million or $2 million, the defense costs are outside that limit. So why is that important? If you have a slip and fall, a personal injury, God forbid a wrongful death, or certainly any kind of liability loss that's going to involve children where one of them are injured, if defense costs go into the hundreds of thousands of dollars, when the defense costs are outside of that $1 million limit, it doesn't eat away from your per occurrence limit you have available to you to make that injured party whole again. If you look at a $300,000 or a $500,000 limit, usually defense costs are listed inside of that limit. So if the same thing were to happen and you have a $300,000 limit, but your defense costs do go into maybe $150,000, you've only got $150,000 left to make that injured party whole again. So there's a greater chance that you're going to have to pay up some additional money out of pocket to make your injured party or parties whole again. Okay, the liability coverage that we offer in our program is really the most comprehensive premises form that, as an investor, you can purchase. And the reason I say that is because I could point out liability coverages and differences all day and probably put everyone to sleep. But I want to point out two of them right now that can be very, very important. One of those is coverage for dog bites with no breed exclusions. So there's a great chance that if you look at your policy right now, you've either got a full canine exclusion, or at least it's going to exclude the top 8 or 9 vicious breeds, which, hey, if all of your investors listened to you when you told them no pit bulls, that wouldn't be any concern, right? But 6 months after they move in, I'm sure a lot of you or some of you have experienced this. They've got pit bulls in the front yard, or German Shepherds or Akitas, or all these really vicious breeds that leaves you as an investor vulnerable, because if that dog gets out and bites someone, you as the owner of the property are going to be named in the lawsuit. So what we did is we built that coverage into our form with no breed exclusions, doing everything we can to protect our investors, right? And the second one to that is pollution coverage, and probably one that you've never thought of, you'll probably never run into, but you'll be very, very happy that you have coverage for this if you do. And pollution coverage on the liability side gives you coverage for carbon monoxide or pollutants that emanate from a heating source inside your home. So if you had a tenant that were to get sick or, God forbid, pass away from carbon monoxide, right now there's a great chance you're on your own to defend that loss, which, as you can imagine, a wrongful death is going to get very, very hairy and expensive very quick. So again, understanding the exposure and wanting to limit the risk associated with this exposure, we built that coverage back into our form. Last point on liability, and we'll kind of jump to the next one, is you have an obligation to your insurance company at the time that you sign in and begin coverage with them to make them aware of any instance that happens on site the second you get wind of it, whether amounts to anything or not. Maybe they never hear about it. Maybe a claim never gets turned in. But at the instant that you hear that something may have happened on site, on your premises, you've got to make them aware of it. Part of what you pay for with your insurance is actually the access to their legal teams. So let the actual experts take over, hand it off to them, and let them do their due diligence and their work. Turning in, and everybody's asking the same question, well, if I do that, does that raise my insurance premiums next year? And that's the answer is no. If you turn in a situation or an occurrence that happens that pays nothing out, then no, it doesn't diminish your ability to get affordable coverage the following year. All we're trying to do is avoid giving the insurance company a reason to decline that liability loss and defending you because you didn't do things the right way. We have investors that have, prior to coming with us, especially before we've actually talked to them and explained this to them, hey, I tried to do the right thing. Maybe I had a client in my house for 10 years. They pay rent on time. One day they fell down the steps, they hurt themselves. Being the good landlord and being the good friend, I tried to do the right thing and help them, get them to the doctor, pay their deductible, right? Pay because they couldn't afford it. And then 2 weeks later, they get another call from them saying, hey, I still don't feel well. So I'd think, wow, as an investor, I want to do the right thing. I want to help my tenant, but this is going to get expensive. I have to keep paying these deductibles for them to go to the doctor. Well, the third time maybe the third or fourth time you hear back from them, it's actually from their attorney who says, hey, your tenant hurt themselves on your premises. I think you need to turn this into your insurance company to make them whole again. So you do it, right? Maybe as an investor you say, wow, now it's time to get them involved. You let your insurance carrier know, and then you get a declination in the mail from them. Regardless of that you're paying your insurance premium, right, on time, you've paid them for coverage because you diminish their ability to defend you and settle that loss by attempting to do it on your own to begin with. So even at the very instance that you think something occurred on site, get them involved. You put them on notice.
Yeah, that's a string of very, very important points. And one of the things that I really took away the last time I heard Shawn speak, we do have a question before we kind of jump into the next slide here. Robert asked, replacement coverage. Can an owner take cash and not rebuild and sell or keep it vacant?
They can. You can always purchase replacement cost coverage and take the cash and not make the repairs like you mentioned, Robert. But you're going to be limited to the actual cash value settlement. So in order to get any depreciation back, you've actually got to make the repairs. So if you're considering doing that, it's probably better off that you purchase an actual cash value policy, understanding that's the one settlement that you're going to get back. And why pay the additional 20 or 30% when you're not going to go back and get the depreciation or be eligible to do so?
Great. Yep, that was just a typed-in question.
Yeah, I see it. So moving on to general contractors policies, I love when I get into a room of investors because I say, hey, everybody in the room is only working with licensed general contractors that are fully insured, right? Everybody raise their hand, and maybe one or two hands go up in a room of 200, and that's because it's so difficult, right? And it certainly can be expensive. A lot of us all engage with handymen and maybe have a family member that is a painter or something like that, and we try to do the right thing and get some cheap labor and get the deals done. But understand that that's an exposure to you as an investor that you don't necessarily need or have to have. And the reason I say that is because every premises liability policy that's available to you as an investor does not extend to anyone that's hired to be on site. So if you've hired someone to come in and paint your house and they fall and they hurt themselves and they try to sue you, your premises coverage does not pick that exposure up. And by the way, that exclusion can extend to a tenant that's in a binding lease with you and paying you rent. If maybe for a portion or maybe you agree with them to allow them to pay decreased rent for a period of time for them to go in and paint your house and they injure themselves doing that. If they come back and they sue you, that's very it's a way for an insurance company to decline a loss, and it's typically excluded off every premises policy available to you. So that's why it's so important to work with licensed and insured general contractors. And by the way, those policies that these general contractors show you, we can make them work for you as the investor, okay? Because we can extend their liability coverage for you for negligence that happens on site due to them. These liability policies that are available to general contractors are pretty cool, but they're very, very tricky. And the reason I say that is because they can purchase these policies that show coverage for an entire year by paying a month or two of premium up front. So for you as the investor, how do you know that general contractor's policy is in good standing month 3, month 4, and you know that they're paying their premiums on time? Well, you can do a couple of things. You can hire a full-time person in-house, and the certificates of insurance that they provide you give you the carrier and the agent that wrote the piece of business, and you can have that full-time person or part-time person calling them monthly to make sure that the policy is in good standing and in good force, or require that your general contractor list you or your owning entity at the property that they're doing work on site be listed as additional insured for the duration of time that they're on site working for you. Now, most carriers and most policies, and I built a couple of general contractors' policies, so I know that's probably better than most, but most of these are actually going to do this for no cost. So if you want to if you go to your GC and say, hey, list my LLC or my IRA as additional insured, their carrier will do that for nothing, right? Understanding why it needs to be done, and it's important. At the most I've seen is charged to endorse the policy is about $50. If your general contractor belly aches about that, it's well worth it to give them the $50 to pay for that endorsement because it could potentially save you millions. The reason I say that is maybe you have a GC that leaves the ladder out in the front yard, and a kid running across your front yard trips and falls on the ladder and injures himself. Not only are you the general contractor going to be named in the lawsuit, but so are you. And the last thing you want is your premises liability policy having to come in and actually do anything more than defend you, which is only going to increase your liability rates for a long period of time, when really they could come in and defend you, which is what you're paying for, to push that liability exposure onto the truly negligent party, and that's your general contractor in this instance. So you can get them. You can get the policy to work for you, and in addition, the second piece of that is being listed as additional insured on their policy guarantees that you're notified prior to that policy canceling for non-payment of premium or any other underwriting reason. So you're going to get notice in the mail, certified. So you can go to your GC and work that out prior to that policy canceling. Usually for non-pay it's 10 days, and for other instances it's 30. So you've got a little bit of a window of time there where you can work with your general contractor to make sure that that policy stays in good standing. Or you get rid of them or kick them off your property until they can prove that they have sufficient coverage again. It also extends to the property coverage. I always tell a war story, and Alex, you probably heard this in Florida, so I'm sorry, man, but it's important that I say this. And and requiring your GC to be insured is so important, because we had a general contractor in Texas that walked up to a house, to a property that we insured, and got stung by a bee, and looked up in the corner of the door frame and had a bee's nest or hornet's nest, whatever it was. And instead of just cutting the nest down or spraying it with Raid later at night and coming back, he decided to take a blowtorch to this thing, and in the process burn down the house, right? So you as the investor, what would you do in that situation? Well, first thing you got to do is turn it into your insurance company, because we're going to come in as your broker and make sure that your insurance company makes you whole again and rebuild that house. But you did nothing wrong in this instance, right? But having your insurance company having to pay out $100,000 or $150,000 to rebuild your home, that's going to increase your property rates for up to 5 years potentially, when you did nothing wrong, right? It's something your GC did. So making sure that they have coverage allowed in this instance for us to subrogate against that general contractor's liability policy and recover every bit of money that was paid out to rebuild that home. So now your property carrier didn't pay out any money. Temporarily they paid out $150,000, but they subrogated back against the GC's policy and recovered all that money. So that stabilizes your property rates long term by doing a couple of small little things to protect yourself as an investor.
Yeah, that as far as stories go, that sounds like that should have happened in Florida. I mean, insurance contractor uses blowtorch to get rid of bees. I mean, that I applaud the state of Texas for having that, but I guarantee you that person probably lives in Florida now. We got another question from Robert, and I'm assuming that this is probably going to be somewhere in the vicinity of something you're talking about with pollution. But he asked, is there insurance in case vacant land cannot be developed? I'm assuming something like, let's say you bought property that used to have like a dry cleaner on there or something, and there was then there's like heavy metal poisoning or something that would mean that the property was and somehow unbuildable, or maybe there's just permanent sinkholes or something that's found to that extent. Can you elaborate on those type of scenarios?
I sure can. And by the way, that's a great question. So there are standalone pollution policies that you can purchase. Now, depending on where you're investing, those can be very, very expensive. And typically, when you're dealing with residential real estate, 1 to 4 portfolios, an investor they'll just throw their hands up and say, yeah, it's probably not worth it, because they typically start at $10,000 of premium and higher, but they would protect against certain instances depending on how the policy is written for cases like what you just mentioned. You got to remember that insurance is typically built for sudden and unforeseen circumstances. So pre-existing conditions, yeah, it's kind of a gray area when it comes to pollution policies, but I can tell you that they're very expensive. It's very strict underwriting. It's difficult for you to get them, especially when you get into the Northeast. So if you're investing in the Northeast, you can pretty well double or triple your cost on that type of exposure just because of how many times and how often it's occurred there. But yes, there are policies that are available for you to purchase out there that could potentially have coverage for that. That answer the question, Alex? We ready to roll?
Oh, yeah, no, absolutely. Yeah, I just leave it up to you
Okay.
to kind of elaborate as much as you
Awesome.
think on
Okay.
there. I'm assuming that's probably what it was about.
Yeah, okay. Yeah, but it's always going to be a standalone type policy, not going to be included in any kind of property policy that you can purchase, can't be added by endorsement. It'll always be a standalone type of exposure. And you can build master policies for that to incorporate your entire portfolio if you're engaging in more than one piece of vacant land at a time that you can add and delete. Monthly reporting is going to be a little bit difficult, so it's typically a big cost out of pocket on the front end. So just like general contractors' policies, renters insurance is important and do the same thing. So, again, when I get in front of a group, I ask them, hey, how many of you, require renters insurance within your lease? Everybody's hand goes up, and I say, that's wonderful. How many of you enforce it month to month? And then everybody's hands go down because it's impossible, especially as your portfolio grows. Maybe you have hundreds of locations. That's a full-time job. So you can do one of two things. You can always require that on your tenant's renter's policy that they add you as additional interest. Now, you cannot be added as additional insured because you have no right to their belongings, but additional interest. And what that is designed to do is to notify you as the landlord prior to their policy canceling, again, for non-payment or for any other underwriting reason. But insurance companies make mistakes, right? I've seen it happen to the tune of millions of dollars where an insurance company fouled up and didn't make the additional insured party aware of a loss, and the owner cut and run with a $2.4 million payout check. So that was on a property exposure, but it's the same thing. They make mistakes. So what we did is we built what's called a tenant protector plan, and that's very similar to renter's insurance. But what it does is passes the cost to you as the investor. So we would charge you, a per unit cost in addition to the property and liability, so that A, you're in charge of that coverage, it's being paid. It's substantially less and it's much more cost effective than having your tenant going out and buying a standalone renter's policy for them. But it does a couple of really nice things. A lot of investors use it as an added benefit to renting from them. Hey, if you rent my house, you don't need to go buy a renter's policy. I take care of it for you, and we just bill it into your rent. But it gives them $10,000 of contents coverage with a $1,000 deductible that they are responsible for. So your property burns to the ground, you're made whole again. Unless they have contents coverage, everything they have is a loss. So essentially, this policy is going to cut them a $9,000 check after the deductible to kind of go and get some clothes and start their life over. More importantly to you is it gives you $50,000 of liability coverage. And what does that do? That covers tenant-caused negligent losses. And that's the most common thing you see, like we mentioned earlier. So if you had that kitchen fire that we talked about earlier for $30,000 worth of damage, as opposed to you having to turn that into your property carrier and, again, potentially paying increased rates for up to 5 years for the insurance company to recover that money they paid out on that loss, they can then subrogate against that the tenant to pick up the entire property exposure. You've got a $50,000 limit of liability and a $30,000 loss. That tenant protector plan is going to pick up that entire loss to where your property policy is not going to have to do it. And I would tell you the average kitchen fire or partial loss on a single-family rental is between $27,000 and $30,000, which is why that limit of liability being $50,000 is so meaningful. It picks up the entire exposure potentially. So it stabilizes your property rates long term, and a lot easier than being listed as additional interest because only about 50% of the insurance companies that will actually sell renters insurance will allow an investor or a landlord to be listed as additional interest. They just won't. Some of the reinsurance contracts will not allow them to do that. So it's just a way for you to eliminate and make your life a little bit easier. With that being said, kind of the end part, one of the end here is why we're different. So, we take occupied, vacant, and renovation properties collectively on one schedule. So it's not a, cancel one policy and start another one, wait for a return premium for 60 days every time your occupancy changes. With us, it's a flip of the switch, and we keep everything on one schedule. Monthly reporting, again, that probably is not going to pertain to location through an IRA. We bill your IRA annually for that. No co-insurance beginning at $50 a square foot. Unique coverage and benefit package. So again, we're going to structure it every opportunity, every investment property that you have. We're going to structure that coverage package unique to what you want and need. No minimum earned premiums, and it goes with that, no long-term commitments. We can do standalone liability coverage only if you'd like. We have some investors that'll pick up a piece of property for $5,000 or $10,000, and prior to them renovating it, if it burns to the ground, hey, they're fine with taking on that risk. They can absorb it. But if you've got liability exposure in a property for even one day and you're wholesaling it, purchase the liability coverage through our program for a month. it's around anywhere from $5 to $10 a month, maybe a little more depending on where the area of the country you're in. But it's liability has a tail on it. So you may be thinking your property that your business is going great, and a property you had ownership in for 1 month 2 years ago. Now you get hit with a lawsuit because Sally slipped and fell and broke her leg, and she's suing everybody that had ownership interest in the property. So for peace of mind and to limit any exposure, purchase that liability coverage. Never self-insure liability. Replacement cost coverage beginning at $70 per square foot, and then again, coverage specific to your business model and not off the shelf. There is our 888 number, as well as our website. And again, if you'd like us to look at a piece of property for you, even if you've got existing coverage in force, we're happy to do a coverage, an apples-to-apples comparison. If you've got sufficient coverage now, we'll be happy to tell you that. But if there are gaps in coverage that could potentially harm you, we will make you aware of it. We'll offer you an alternative. That's our 888 number. My direct number is 816-398-4096. That will ring to me or my assistant because I am on the road a lot. I'm happy to talk to anyone that's listening and kind of help them along the way.
Great. We thank you very much. We got a couple good questions that popped in. Do you over at NRAEG offer commercial coverage?
We do. I actually own a full-line commercial agency, so once you get out of the 1 to 4 family world, you name it, we can write it.
Great. And Robert, again, with the good questions rolling in, if a healthy tree on IRA land and a storm falls on a non-IRA house that has no insurance coverage, would the IRA landowner be responsible for the non-IRA total loss? So I'm assuming tree falls from property that's insured with the IRA onto other property that property has no insurance. Who's responsible in that area? And I believe this does boil down to whether it is a named windstorm or not, correct?
Not necessarily. Usually in that instance, it's where the damage takes place. So if that individual has no insurance, it's kind of on them. Depends on the carrier. Some of them will jump in and at least offer a sublimit because most policies come with a sublimit for trees and shrubs that do damage of maybe $2,500 or $5,000. That at the most they'd pay that out. It's never up to the policy limits that I know of.
Okay, great. Yeah, it's one thing I was never sure of. I've heard many different things regarding, what happens when trees fall and whether or not it's a hurricane or a named windstorm or all that kind of good stuff. So great. We're right up on an hour. I'd love to thank Shawn very much for being a part of this today. It's always great to have people come in and speak very knowledgeably on subjects such as this. Real estate is certainly something that all real estate investors need, especially through IRAs, since it is a little bit different than writing policies, and good to have someone come in that can certainly speak knowledge on that. So if you have questions regarding insurance, obviously his number is right up there. If you have questions that we can help you with on the IRA side of it, my number is right up here on the screen as well. Again, thank you very much, Shawn, for being a part of this today. We hope to be able to maybe do one of these in the future or something so we can make sure that we get the information back out there. With that said, we're hitting right on an hour, so we'll let everyone get back to their day. Again, thank you very much for joining us, and have a wonderful rest of your day.